When you see the Chinese regulators limiting stock sales by major shareholders, by company executives, and by corporate directors, it does give you pause, does it not? How do we take that action, which came a couple of days ago, and the overnight rebound in Chinese stocks, and make some sense of it all?
It does. Well, I mean, I think you've got to look at the market locked up 10% today. They've thrown everything at it. 95% of the tradable index was a limit up. And so you're getting these headlines saying it's the biggest gain since 2009. But when you look at it, you'll actually see that 1,260 stocks were actually suspended from trading anyway, as you know, a lot of companies have elected to do so. And then you look at the sort of like confines that have been brought in, the fact that if you own over 5% of a company, you can't sell it for 6 months. The 260 billion of renminbi that was given to 21 brokers across the street, they have literally thrown everything at this market.
Now, we've seen retail investors in China get a lot more involved in investing. With market action like this, what happens to the retail guy?
Oh, gosh, it's a good question. We don't know so much. I mean, one of the things one has to remember is what the broader market ramifications are. Is the fact that China's gone up on its own as a function of a lot of those retail buyers buying. It's been less sort of an institutional participation. And so one of the things you're seeing, and you can see that the DAX has been up the last couple of days, other markets have been less exposed to it. This has been a relatively sort of isolated phenomena contained within China. I mean, we are seeing the ramifications in the last day with what happened with iron ore, with what's happened with oil as well, and also the knock-on effect to the Hang Seng into the H shares. But a lot of it has been a function of this search to try and fund their margin calls, and that's why the markets have been hit.
Nick, I was sent overnight a couple of charts on Chinese stocks that I found particularly useful, and they illustrated that Chinese stocks traded in lockstep with the Shiller PE, the cyclically adjusted price-earnings ratio for the listed companies for a long period of time. And then all of a sudden, in 2014, there was this massive divergence suggesting, of course, that there is a bubble had begun to build and perhaps continued to build until last month when the stock started to sell off really hard. Do you agree with that analysis? And I should add, by the way, I want to give full credit to the guy who sent it to me because it was unsolicited. It was from a guy named Mayank Gupta, who had done this Shiller PE research on Chinese stocks as part of his PhD dissertation.
Okay, we've seen things like that. I think what happened, and we're obviously facing another bubble with what we're trying to do with the containment in Greece as well at the moment. I think things like the liberalisation of the Chinese market through Stock Connect sort of fueled it. And I think at some point in time, and obviously we see it maybe too late, there probably should have been intervention a lot sooner rather than there has been. It was allowed to fuel, like all bubbles historically have. Done in the past, and I think it just got caught up with itself. I mean, we all hear the stories of the crowds of sort of retail investors, you know, getting heavily levered to be able to invest into this market. We've obviously seen poor, weaker car sales because people are diverting cash away to invest it into the stock market. We've seen the liberalisation of credit and the provision of greater and less stringent margin facilities to retail investors. We've seen banks obviously provide their own stock as collateral. It's sort of had classic bubble characteristics of feeding itself, and that's the situation we're in now.
Nick, you spend your days speaking to macro hedge funds. How are they faring this week? One might guess they're getting whipsawed.
Yeah, but at the same time, remember, we've socialised a lot of risk in Europe. I talk about the idea that this is quite, I mean, I was in Asia in Singapore at our Access Asia conference a couple of months ago, and you know, it was quite localised how much interest there was in things like Shenzhen Connect and Hong Kong Connect. A lot of the macro guys, I wouldn't say have seen this because that would be probably giving too much credit, but they haven't participated to the extent that one would have imagined they would have done. I think when you look at the market so far this week, their resilience shows you how much they've socialised a lot of the risk around things like Brexit. I think there's sort of relatively specific risks in China and in Puerto Rico as well. And I think in terms of how they fared, I think June was pretty brutal. I think July's been better.